Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, STERIS, the global sterilization leader that just closed its fiscal year with 9% revenue growth and record free cash flow.
STERIS traces its roots to AMSCO International, an Ohio company founded in 1985 that built sterilization equipment for hospitals. It became STERIS Corporation in the 1990s and went public on the NYSE.
In 2015, STERIS merged with UK-based Synergy Health, creating STERIS plc, an Irish-domiciled company with a global network of contract sterilization facilities serving medical device manufacturers worldwide.
Daniel Carestio became president and CEO in 2021, previously COO. His focus has been recurring service revenue growth and margin expansion across all three business segments.
Most recently, full fiscal year revenue was $5.9 billion, up 9%, with adjusted EPS of $10.17, growing 10%. Full-year free cash flow reached $983 million, a record.
For fiscal 27, STERIS guided adjusted EPS of $11.10 to $11.30, 9 to 11% growth, with revenue growth of 7 to 8% and a new $1 billion buyback.
The moat is the installed base. Hospitals and device makers that embed STERIS into their quality systems become long-term customers for consumables, maintenance, and service contracts.
Switching providers requires formal regulatory revalidation, a process that takes years for medical device companies. That switching cost makes STERIS's customer relationships extraordinarily durable.
The Applied Sterilization Technologies segment is STERIS's highest margin business, a global network of contract facilities processing medical devices for manufacturers without their own sterilization capacity.
Healthcare grew 7% to $1.40 billion. AST grew 6% to $289 million. Life Sciences grew 9% to $163 million, balanced growth across all three segments.
Against medical technology companies, STERIS competes as enabling infrastructure rather than a device maker, giving it relationships inside quality and compliance functions rather than clinical procurement.
The international opportunity is real. Sterilization standards in emerging markets are rising to developed world levels, expanding demand for STERIS's contract and equipment segments.
Capital allocation has been consistent. Reinvest in facilities, execute bolt-on acquisitions, return capital through buybacks and dividends, and maintain investment-grade leverage.
Dan Carestio drove STERIS's operational transformation as COO before becoming CEO in 2021, focused on mix shift towards service revenue and free cash flow conversion.
Free cash flow of $983 million represents strong cash conversion, a function of the recurring asset-light service model, generating working capital efficiency unavailable to equipment businesses.
The market reaction was sharply negative. Guidance came in below elevated consensus. The underlying business remains a consistent compounder with high recurring revenue and strong cash generation.
The $1 billion buyback, funded by record free cash flow, signals management confidence in intrinsic value and creates per-share return opportunity if the stock stays under pressure.
STERIS just wrapped its fiscal year with 9% revenue growth, record free cash flow, and a new $1 billion buyback.
Let's walk through the healthcare sterilization numbers and what the fiscal 27 guide really means.
Infection prevention, contract sterilization, recurring service revenue. STERIS is the infrastructure that keeps hospitals and medical device makers operating safely. Now let's get into the numbers. STERIS, the global leader in sterilization and infection prevention, delivered a mixed quarter for fiscal Q4 2026. Revenue of $1.6 billion grew 7% and beat estimates, but adjusted EPS of $2.83 missed the $2.89 consensus by 6 cents, a small miss that headlines the print. The real story is the FY 2027 guide of $11.10 to $11.30 and the first share repurchase program in STERIS history.
STERIS is a global leader in sterilization, infection prevention, and surgical support, serving hospitals, pharmaceutical manufacturers, medical device companies, and research institutions. The company operates three segments: healthcare, which provides sterile processing and surgical support equipment to hospitals; applied sterilization technologies, which offers contract sterilization services including gamma, E-beam, and ethylene oxide processing; and life sciences, which serves pharmaceutical manufacturers with sterilization equipment and validation services.
STERIS is headquartered in Dublin, Ireland, with its operational center in the United States, employing approximately 17,000 people globally. The company has a fiscal year ending March 31st, making fiscal Q4 2026 cover January through March 2026. Fiscal 2026 full-year revenue reached $5.9 billion, a 10% growth business, underpinned by the structural necessity of sterilization in every hospital, pharmaceutical facility, and medical device manufacturing plant in the world.
Fiscal Q4 2026 revenue of $1.6 billion grew 7% year over year and beat the $1.595 billion estimate. The healthcare segment, surgical support, and sterile processing equipment for hospitals drove the majority of growth as hospital procedure volumes continued their post-COVID recovery. Applied Sterilization Technologies segment also contributed positively as contract sterilization capacity utilization increased with recovering medical device production volumes.
Adjusted EPS of $2.83 missed the $2.89 consensus by 6 cents, a 2.1% shortfall that was the headline negative in an otherwise solid report. The miss reflected slightly higher than expected operating costs in the life sciences segment, as pharmaceutical clients pushed project timelines, and some incremental margin pressure in the Applied Sterilization Technologies segment from startup costs at newly expanded sterilization capacity. This is not a structural miss, it is a timing miss.
Full fiscal year 2026 adjusted EPS reached 10% growth over the prior year. This marks the 5th consecutive year of adjusted EPS growth above 8% for STERIS, establishing a track record of consistent earnings, compounding that justifies the premium multiple the stock has historically commanded relative to medical device sector peers with more cyclical revenue profiles.
Free cash flow for fiscal 2026 was $982.9 million, a 16.6% free cash flow margin on $5.9 billion in annual revenue. This FCF generation positions STERIS in the top quartile of the healthcare equipment sector and directly funded the announcement of its first-ever $1 billion share repurchase program, the most significant capital return development in the company's history.
Balance sheet leverage stands at approximately 2.8 times net EBITDA, total debt of $3.9 billion against $420 million in cash. Net debt of $3.48 billion is elevated but manageable given the predictable revenue base and strong free cash flow generation. The company's investment-grade credit rating allows it to refinance debt at favorable rates while simultaneously executing the buyback program and funding organic growth capital expenditures.
Daniel Carestio became president and CEO of STERIS in 2021, succeeding Walt Rosebrough, who led the company for 14 years. Carestio joined STERIS in 2000 and was part of the leadership team that transformed the company from a single-segment sterilization equipment provider into the 3-segment global platform it is today, including overseeing the $21 billion Cantel Medical acquisition in 2021 that dramatically expanded the healthcare segment.
Analyst consensus heading into fiscal Q4 was 5 buy ratings, 2 holds, and 1 sell. A buy-weighted setup with some caution around the EPS trajectory. The average price target of $275 represented approximately 28% upside from pre-earnings levels of $215. Post-earnings, Baird maintained outperform and Needham maintained buy, both citing the FY 2027 guidance as the more important metric than the 6-cent quarterly EPS miss.
Baird's post-earnings note focused on the FY 2027 guidance of $11.10 to $11.30 adjusted EPS as the primary signal.
Needham took the same position. The 6-cent miss is noise. The FY 2027 guide is the signal. Their analysis argues that STERIS's pricing power in mission-critical sterilization services is underappreciated. Hospitals cannot defer sterilization. Pharmaceutical manufacturers cannot risk product contamination. Medical device companies cannot ship unvalidated products. This pricing power insulates STERIS from the cost inflation and reimbursement pressures that compress margins at pure device or services companies.
The bear case for the one cell-rated analyst centers on the Cantel medical acquisition integration costs. The $21 billion purchase added significant goodwill and created multi-year integration drag on free cash flow conversion. At $3.9 billion in total debt, STERIS is carrying leverage that limits financial flexibility and creates sensitivity to interest rate movements. The cell-rated analyst argues the premium multiple requires EPS growth execution that the Q4 miss calls into question.
The consensus, the 6-cent miss is the headline. The $1 billion buyback is the story. STERIS management is signaling confidence in the multi-year earnings trajectory by deploying $983 million in fiscal 2026 free cash flow into the first buyback in company history. At $215, analysts broadly view the stock as offering a compelling risk-reward at 22 times FY 2027 earnings.
The bull case is the structural necessity moat. Sterilization is not a discretionary service. It is a regulatory requirement for every hospital, pharmaceutical plant, and medical device manufacturer in the world. STERIS is not competing for demand. It is the infrastructure through which healthcare operates. This creates pricing power that compounds quietly. STERIS raises prices annually on long-term contracts with clients who have no viable alternative to sterilization compliance.
The applied sterilization technology segment is the most underappreciated growth driver. As medical device production volumes recover from post-COVID normalization and pharmaceutical outsourcing increases, AS to contract sterilization utilization rates are rising toward capacity limits, which means STERIS can raise prices or expand capacity at superior economics. The segment's margin profile improves structurally as fixed cost capacity investments from 2022 and 2023 are now running at higher utilization rates.
The $1 billion buyback is the third catalyst. STERIS has never repurchased shares at scale before. This program represents a fundamental shift in capital allocation philosophy.
The 6-cent EPS miss is the bear case entry point. At 27 times trailing earnings, STERIS trades at a premium that requires consistent execution. A 2.1% EPS miss signals that either pricing power is slightly weaker than modeled, or that operating costs are rising faster than revenue, both of which compress the premium multiple if they represent trends rather than single-quarter timing.
The $3.9 billion total debt at 2.8 times EBITDA constrains financial flexibility in an era of higher interest rates.
Ethylene oxide regulatory pressure is a specific risk for the applied sterilization technologies segment. The EPA has been tightening regulations on EO sterilization facilities, which are used to sterilize medical devices that cannot withstand heat or radiation, due to community health concerns about EO emissions. Any facility closure or throughput limitation at STERIS's EO sterilization plants would directly reduce AST segment revenue with limited ability to switch capacity to alternative sterilization modalities in the short term.
The valuation debate is real. At $215 and 27 times trailing earnings, STERIS is not cheap. A sector derating, driven by rising interest rates or multiple compression across medical technology, would disproportionately impact STERIS relative to lower multiple peers. The premium requires consistent double-digit earnings growth delivery. 2 consecutive misses would likely trigger a meaningful valuation reset.
3M's Health Sciences division, now partially divested, provides the infection control comparison in hospital and laboratory settings. STERIS operates at higher EBITDA margins than the remnant 3M Health Science segments because sterilization services are contractual, recurring, and non-discretionary, while 3M's disposable products face commodity pricing pressure. The moat comparison favors STERIS significantly.
Waters Corporation is the analytical instruments peer, serving pharmaceutical manufacturers and research institutions with chromatography and mass spectrometry equipment. Waters operates at a similar premium valuation to STERIS, reflecting the mission-critical nature of analytical validation in drug manufacturing. Waters' revenue model is also heavily service and consumables-driven, a recurring revenue structure that STERIS shares through its sterilization validation and maintenance service contracts.
Biorad Laboratories provides the life sciences research comparison. serving academic labs and pharmaceutical manufacturers with research tools and clinical diagnostics. Bio-Rad's valuation discount to STERIS reflects its higher exposure to the more volatile research spending cycle and its less critical position in the manufacturing quality chain. STERIS sits deeper in the pharmaceutical production necessity stack, where stopping sterilization stops the entire manufacturing line, giving it superior pricing power relative to Bio-Rad's instrument sales model.
Options activity was mixed post-earnings, reflecting the push-pull between the revenue beat and the EPS miss. Put-call ratio of 0.92 reflects balanced positioning. Call buyers attracted to the buyback announcement and FY2027 guidance. Put buyers hedging the 6-cent miss and the elevated 27 times earnings multiple. The balanced PCR suggests institutional investors are not making large directional bets at current levels post-earnings.
Near-term options implied a 5 to 7% move on the earnings print. The stock's modest response to the mixed results suggests the market had partially anticipated both the revenue beat and the EPS miss from guidance modeling. The $1 billion buyback announcement was the surprise element. It was not widely expected by analysts and triggered the intraday support that kept the stock from declining more significantly on the EPS miss headline.
CEO Daniel Carestio and the STERIS management team maintain equity positions through compensation plan structures aligned with adjusted EPS targets.
No significant insider selling was reported in fiscal Q4. The combination of zero insider selling and a $1 billion company-level buyback creates a clean insider alignment signal despite the EPS miss. Institutions watching for post-miss insider selling, a common warning sign that management sees structural problems, received the opposite message: a buyback at the company level and zero selling at the individual level simultaneously.
STERIS missed by 6 cents on EPS but delivered 7% revenue growth, 10% full-year EPS growth, nearly $1 billion in free cash flow, and the company's first-ever buyback program.
Bull case: the buyback at 22 times forward earnings is accretive, AST utilization improves, and STERIS re-rates to 275 as analysts model. Bear case: EO regulatory pressure limits AST throughput and the premium multiple compresses on consecutive misses. The structural necessity mode is real. The execution needs to be consistent.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.